Clark Geranen joins us here. He's Chief Market Strategist and COO of Cal Bay Investments, located in Danville, California. I know where Danville, California is because I pass by when I drive from Carmel to Lake Tahoe.
So that's a beautiful area.
It's on the 680. It is beautiful.
Yeah.
It is awesome out there, kind of east of San Francisco. Beautiful out there. Crumbs, breakfast, lunch, and bar. I stop there for food occasionally. Ooh. Clark, thanks so much for joining us there. What's got your attention these days? Is it Jackson Hole? Is it earnings? What's kind of driving how you're looking at this market these days?
So I think it's a mix of both Jackson Hole comments coming out tomorrow with Jerome Powell, as well as some of the new inflation data. So we saw the markets actually not react too much to the producer inflation number last week. And I think the recent pullback that we've seen has really been more anticipating what Jerome Powell's comments are going to be on Friday. We even saw some big earnings come out this week, which really were a mixed bag on some of these companies. We've seen some actually produce higher guidance, which was very great. And we've seen others where there's been CEO switches and have really been a little bit more worrisome. So I think we are anticipating that we'll see a rate cut next month. And as long as we just see some of these inflation numbers stay intact, then we may continue to see rate cuts this year.
How are you planning to kind of suss out his particular rhetoric? Because I know you said you were expecting a cut. I mean, is it a slam dunk after we saw those revisions to the latest jobs numbers? Or is there still a risk that even if he's open to a potential cut, that they might still hold steady after that?
So I think at this point, it is a slam dunk for the one rate cut next month. But I think it'll be interesting to see what his comments are just looking forward, both on the unemployment and inflation, just because if we do see a tick up in consumer inflation, which after seeing the producer numbers, we do anticipate. And I think that just kind of goes back to Jerome Powell's stance of being so hawkish. And obviously he has the outside pressures of the administration on him right now. And so if we see another tick up, we really think that could be just one rate cut this year, one and done, move on into next year and reevaluate just based on how data dependent Jerome Powell has been.
So Clark, are you in a camp that says that this is a market that's kind of moved past the whole tariff as a risk/crosswind headwind type thing?
I don't think we're fully past that headwind yet. We have seen that a lot of companies have been borning a lot of that tariff cost themselves. And so I do think that we're going to continue to see this move more towards the consumer. That being said, I do feel like it will be sort of a one and done as far as inflation goes. So we may see this tick up, above 3%. But my anticipation is over the next year, we will see that number start to creep back down towards the 2% number. So I think we're kind of in this waiting period over the next 6 months of seeing inflation tick up and then start to come back down. So that's why I'm really only looking at the one rate cut next month.
Hey, Clark, I was looking at Citigroup's earning revision momentum coming into this week, and it was actually hovering around its highest in almost 4 years. So obviously some companies getting that relief on some parts of the tariffs being delayed. But then also, if you look at the PPI versus CPI spread being in negative territory, the translation of what that means for corporate margins, how do you view that as far as what margins look like, maybe those more consumer-related companies, and how that translates potentially into their stock prices in the coming weeks and months?
So I think what we're going to see is the companies start to transition some of that tariff cost onto the consumers. And so I think that's the only way that they're going to be able to make up for their margins is by moving some of that cost over. So I do think that's why we are going to see a tick up in consumer inflation. I think it's the only way that the companies are going to be able to move forward. And like we saw with Walmart this morning, they actually provided positive guidance moving forward. Although they didn't necessarily beat earnings, I think just hearing some of that positive guidance has been really important, just because over the past 6 months, companies were giving maybe 1, 2, or 3 different outlooks, and that just provides no consumer confidence. And so I think that's why there's been such hesitancy from investors to jump back into the market. And now we're seeing this fear of missing out, or FOMO. And that's also what's helped driven the market.
Clark, what sectors are screening well for you these days?
So we are still very bullish on infotech, financial that we've seen. And some of it goes back to what we were really looking at the beginning of this year, which was hopefully seeing lower interest rates, potentially mergers and acquisitions, specifically on the financial side, as well as more of the AI related drivers for healthcare.
Well, specifically when you were calling out infotech too, I know you were talking about AI. What about when you're thinking about maybe some of those growth stocks that are tied to either software companies versus chip makers, and which ones you would recommend having more exposure to?
So we do like software sector right now. And I think if we're taking a look at valuations as a whole, at the beginning of the year, we were very stretched. And so as we saw those come back down, we really have seen the S&P 500 actually converge with international. And so that was something that we found very interesting with the ACWI now matching the PE of the S&P 493. We kind of think now we want to keep our money here in the US because of this convergence. But as we've seen the Mag 7 PE move up back to where it was at the beginning of the year, I wouldn't say that we're bullish on the overall Mag 7 or Infotech. So I think it comes down to more of individual stock selection at this point.
So how do you guys screen for stocks? Is it valuation driven? Are there sectors you like? How do you kind of do the top down?
Sure. So valuation driven and also just being in the Bay Area, we do have great researchers and people that we're able to rely on in order to be able to get more information about these companies more readily.
I know also you were keeping a close eye when it comes to financial companies. And I feel like financial companies, I mean, that's a big umbrella, whether it's big banks, regionals, also insurance companies, maybe even you could throw in potentially fintech companies there. Or is there a particular pocket within financials that you prefer more so than others?
Sure. So we've definitely been looking at insurance companies. And as we've seen, there have been some. Let's take a look at Berkshire Hathaway, for instance. I think most people would say that they've had a rough year, but there are so many insurance companies that have continued to do well. Regional banks are also something that we like to look at. So really all of the above, because we think there's a lot of runway for them, just considering a lot of the drops in interest rates that we know over the next year, most likely going to happen, especially with the push from the administration.
All right, Clark, great stuff. Thanks so much for joining us. Clark Geranen, Chief Market Strategist and CEO of CalBay Investments.